Hello and welcome back to Global Value. In today's video, we're performing a fundamental stock analysis of Walmart Inc., ticker symbol WMT. We're looking at Walmart today because the company has consecutively increased their dividend payouts in each of the past 49 years. This means that Walmart is only 1 year away from becoming a dividend king. So dividend kings are businesses that are members of the S&P 500 who have consecutively increased their dividends for each of the past 50 years. It's likely that Walmart will keep increasing their dividend payouts. If this is the case, this means that next year Walmart will join the likes of businesses such as Johnson & Johnson, Coca-Cola, and Procter & Gamble, as well as their retailing peer Target, in becoming dividend kings, which is really a select group of companies that have had these phenomenal track records. So right now, Walmart is trading for $150.23 per share. Over the past year, their stock price is up about 6%. Over 5 years, Walmart is compounding at a rate of 8.5% annually. Over 10 years, they're compounding at a rate of 7.5% annually. And going back prior to the global financial crisis, Walmart's stock price has compounded at a rate of about 5.5% annually. So keep in mind that this is not including their dividends, and currently Walmart is paying out a 1.5% dividend yield. So that would be in addition to this compound annual return. Currently, Walmart is trading $10 below their 52-week high, and they're up more than $40 from their 52-week low. Walmart is one of the world's largest businesses. They have a $408 billion market cap. For background about the business, America's largest retailer by sales, Walmart operated over 10,500 stores under 46 banners at the end of fiscal 2022, selling a variety of general merchandise and grocery items. Its home market accounted for 82% of sales in fiscal 2022, with Mexico and Central America coming in at 6% and Canada coming in at 4%, which are its largest external markets. In the United States, at the namesake stores, around 56% of sales come from grocery, 32% come from general merchandise, and 11% from health and wellness items. The company operates several e-commerce properties apart from Walmart.com, including Flipkart and Shoes.com. It also owns a roughly 10% stake in Chinese online retailer JD.com. Combined e-commerce accounted for about 13% of fiscal 2022 sales. The company was founded in 1945 by Sam Walton and is based in Bentonville, Arkansas. So for our fundamental analysis today, we are performing the Select 6 analysis, taking a checklist-style approach of 6 standard financial metrics to come to a holistic and beginning understanding of Walmart based on their business fundamentals. So this analysis is still a work in progress. It will continue to evolve and improve and get better over time, and it's an opportunity to learn in public. So with that said, let's get right into today's analysis. Starting things off with metric number 1, we want their average return on capital over the last 5 years to be above 14%. So there are 2 major reasons for this. The first is that over the long run, over the course of decades, a stock is likely to return approximately what its underlying business returns. And the second is that the average publicly listed business earns about a 7% return on capital. So Walmart has produced pretty steady returns on capital, averaging out in the mid-teens over the last 5 years. Over their last 12 months, they produced 14.5% returns on capital, and averaged out over this time, Walmart is earning 15.5% returns on capital. So that's slightly above that 14% benchmark we're looking for. And this is a check to start off on metric number 1. The reason we look for 14% is that we can potentially build in some margin of safety for ourselves based off the overall quality of the business being about twice as good as average, and that would seem to be the case here for Walmart. Next up for metric number 2, here we're looking for revenue, net income, and free cash flow growth over the last 5 years. We'll also be including their last 12 months worth of numbers. So over this time, Walmart has grown their revenues by about 17%. Their net income or their earnings have increased by more than 40%. However, their free cash flows are down very significantly. Including their last 12 months, their free cash flows are down more than 70% from where they were during fiscal 2018. This huge drawdown in their free cash flows was in part what really caused Walmart stock to crater earlier this year. A lot of this was on the back of inventory buildup. So we don't want any of these 3 numbers to be down. But as an owner in a business, the one we especially don't want to have down is free cash flow. And this is because free cash flow is really the lifeblood of any business, and a business's abilities to produce free cash flows now and until Judgment Day, discounted back by some reasonable interest rate, is ultimately what that business is going to be worth. A business can use free cash flows to buy back shares, pay dividends, make acquisitions, reinvest back into the business, or pay down debt. It's not great that Walmart has seen such a serious decline here, although it seems like this could potentially just be a short-term hiccup for the business, and ultimately, over the long run, you're concerned about what Walmart is going to be like 10, 15, or 20 years out into the future. So this is going to be our first X here on metric number 2. Metric number 3, here we're taking the perspective of an individual shareholder in the business by looking at Walmart on a per share basis. So we're looking for earnings per share growth over the last 5 years. So over this time, Walmart has grown their earnings by more than 40%, and additionally, they've repurchased about 8% of their shares outstanding. So in this earnings per share equation, the numerator, their earnings have gone up, while the denominator, their shares outstanding, have gone down. So this is a check here on metric number 3, as they've experienced strong earnings per share growth. It's nice to see that they've been buying back shares, because when you purchase a share of stock, what you're really buying is a fractional ownership percentage in that underlying business. So when a business decreases the number of shares that they have outstanding by repurchasing stock, they're actually increasing your ownership percentage in the business, which is going to increase your percentage of the business's profits without you having to spend a dime. So it's almost as if Walmart is making an acquisition of itself. And so just like with any other acquisition, we want a company to be buying back shares when it's going to be value acquisitive for existing shareholders going forward. Metric number 4 is going to be very similar. Here we're looking for free cash flow per share growth over the last 5 years. So again, Walmart, including their last 12 months worth of numbers, has seen their free cash flows drop by more than 70%. At the same time, they have repurchased 8% of their shares outstanding. Even with their share repurchases, their free cash flows are still down at a rate that's much faster than this, meaning that their free cash flows per share are down as well. So this is an X here on metric number 4, and so far through our first 4 metrics, we're split evenly, 2 checks and 2 X's for Walmart. Next up, metric number 5, here we're evaluating how the business is utilizing leverage. So we don't want to be investing in overly levered businesses, because during economic downturns, overly levered businesses are at the greatest risk of poor financial outcomes. So we want to see that their net debt, which is long and short-term liabilities minus cash and short-term investments, is below the amount of free cash flow that Walmart has produced over the past 5 years. So at the end of their fiscal 2022, Walmart had about $44 billion in net debt. Since then, this has increased to $53 billion worth of net debt. This is occurring at the same time that their free cash flows are coming down. However, over the last 5 years, Walmart is still earning way more than enough to be able to pay off all of this debt by bringing in a ton of free cash flow. Walmart has produced $87 billion worth of free cash flow over this time, which is just an absolutely huge number. There are very few businesses in the world that are putting up numbers at the scale that Walmart is. And so even though they have $53 billion in debt, it looks like that is a reasonable and appropriate amount of leverage for this business based off their abilities to produce free cash flows. So this is another check on metric number 5. So far through our first 5 metrics, we have 3 checks and 2 X's. Then the big metric of them all, metric number 6, we want their average free cash flows to their total enterprise value to give us a yield that's above 5%. If this is the case, this will give us a slight risk premium to the rate of the 10-year Treasury yield, and potentially give us another reason to be interested in Walmart. Using their total enterprise value is going to give us a picture of the economic realities of the business that are more similar to as if Walmart were a private company. So currently they have a $470 billion total enterprise value, and we learned that over the past 5 years, Walmart has produced more than $87 billion in free cash flow. This means that in an average year, they're producing about $17.4 billion worth of free cash flow. So when we divide their $17.4 billion of average free cash flow by their $470 billion total enterprise value, that is going to give us an average free cash flow to enterprise value yield of 2.6%. That's just over half of that 5% we were looking for, and that is less than the rate of the 10-year Treasury yield. So on an average basis, this is an X on metric number 6. Worth keeping in mind as well is that their free cash flows have come down quite a bit over their last 12 months compared to where they've been at historically. So over their last 12 months, Walmart has produced $7 billion worth of free cash flow. So to get a current free cash flow to enterprise value yield for Walmart, when we divide their $7 billion of their last 12 months worth of free cash flow by their $470 billion total enterprise value, that only gives us a current free cash flow to enterprise value yield of 1.5%. So that's worse than where they've been at historically. That would seem to indicate that there's quite a bit of rebound in their free cash flows being priced into the business currently. So even though their free cash flow woes may be a temporary hiccup for their business, it looks like Mr. Market is pricing in that Walmart is going to be able to get back to where they've been at historically. Then here we're taking a look at Walmart's dividend profile. So as mentioned, Walmart is almost a dividend king. They're definitely a future dividend king contender. They've consecutively increased their dividend payouts for each of the past 49 years. They only need one more year of increasing dividend payouts to become a dividend king. Walmart has pretty incrementally, pretty slowly but surely grown their dividends in each of the past 5 years. And over this time, they've had more than enough free cash flow coming in to be able to healthily support this dividend. Although with their recent decline in free cash flow in fiscal 2022 and over their last 12 months, this does look like this is applying pressure as they're paying out a higher and higher percentage of their free cash flows as dividends. However, if their free cash flows are able to rebound as it looks like it's being anticipated, then even with the recent declines in free cash flows, Walmart would still be able to support a small and modest growing dividend. Again, this is just looking at what Walmart has done over the past 5 fiscal years and their last 12 months worth of numbers, and this is not necessarily going to be 100% accurate going forward into the future, but it at least gives us a starting point for what to potentially anticipate. There's also a lot of psychology and incentive that goes into becoming a dividend king, so that potentially weighs into management's considerations as well. Then here we're using a discounted cash flow model to come to a potential fair value for Walmart. So starting with an average of their free cash flows over the last 5 years, which is different from where their free cash flows are at currently. If we were projecting out their current free cash flows into the future, then this analysis would look extremely rough for Walmart. So projecting these average free cash flows out into the future over the next 20 years to give us a baseline estimate for where Walmart could be, using historical growth assumptions for the business based off their abilities to grow their free cash flows since 1990. So if we assume a growth stage for the business over the next 10 years, where they're able to grow their average free cash flows by a rate of 10% annually, and then using a terminal stage out over the next 10 years out after that, where that growth rate falls in half to growing at only 5% annually. If we add in their tangible book value and we were seeking a 10% rate of return for the business, then it looks like a potential fair value for Walmart would be about $107 per share. That's down more than $40 from where their stock price is at currently. Using these same historical growth assumptions, which you need to do your own due diligence on, to determine whether or not these are both going to be accurate and potentially applicable going forward for Walmart. It looks like from today's valuations, you could reasonably expect about a 6% rate of return going forward from Walmart. Keep in mind that this discount rate would be including Walmart's 1.5% dividend yield. So it looks like from today's valuations, their stock price could reasonably increase at a rate of about 4.5% annually. Also worth mentioning is that a discounted cash flow model, just like any other model in any other discipline, is going to have its outputs be sensitive to its inputs. So as you learn more about Walmart as a business, you'll be able to tweak these inputs to give a better estimate of what the future could potentially look like for Walmart. Also, please be aware that this type of analysis is not financial advice. It's not a buy or sell recommendation of any security. And before considering any potential investment decision, please consult with the properly licensed and registered legal and financial professionals. So in summary, Walmart checks the box on 3 out of 6 of our metrics. They're earning average returns on capital of about 15.5% annually. They've also grown their revenues and earnings over the last 5 years, but their free cash flows are down pretty significantly. They've been hit especially hard due to inventory buildups over the last 12 months or so. However, even with that, Walmart has repurchased about 8% of their shares over the last 5 years. And based off their historical abilities to grow their free cash flows over the past 5 years, it looks like they're using an appropriate and reasonable amount of debt in their business. Then both on a current and average free cash flow basis, it looks like Walmart's yield compared to their enterprise value is not going to give us the adequate risk premium that we'd ideally be seeking in comparison to the rate of the 10-year treasury yield. Then looking at their dividend profile, Walmart is 1 year away from becoming a dividend king. It would seem like even with their recent declines in cash flows that they'd be able to achieve this, but in order for them to keep increasing their dividend going into the future after this, it's likely that their cash flows would need to rebound and get somewhere back into the vicinity of where they've been at historically. Then finally, performing a discounted cash flow analysis of Walmart using historical growth assumptions, which you need to do your own homework on. If you believe those assumptions, it looks like from today's valuations, you could reasonably expect about a 6% rate of return going forward from Walmart over the next 20 years. There are a number of reasons why this growth would potentially not be applicable to Walmart, especially because as a business gets bigger, its growth rates tend to slow down as it matures. And Walmart is one of the largest businesses in the world. It's worth reiterating that this type of analysis is not financial advice. It's not a buy or sell recommendation of any security. And before considering any potential investment decisions, please consult with the properly licensed and registered legal and financial professionals. Instead, this analysis serves as a beginning and holistic understanding to help you determine whether or not it's worth your time to dig in and learn more about Walmart. One resource that will definitely help you stay up to speed with what's going on in the market and help you learn more about the business is Seeking Alpha. Checking out Seeking Alpha directly supports the channel as I'm part of their affiliate program. So most of you probably know Seeking Alpha as a source of community-written articles on different stocks. But over the past little while, they've actually become a lot more than that with their new offering, which is Seeking Alpha Premium. Premium has a number of different features where you can track buy, hold, and sell ratings on your favorite stocks. These ratings are from the Seeking Alpha community, Wall Street analysts, and Seeking Alpha's algorithm. You can see earnings call transcripts, investor presentations, SEC filings, and press releases all in one place. You can add your own margin of safety targets and get alerts for when your favorite stocks hit that level. You can get unlimited access to Seeking Alpha articles, and you can tailor your reading experience based on the type of investor you are. You can get 10 years of financial data on any stock to help you with your analysis. You can also import your portfolio into your Seeking Alpha dashboard to make researching easier. And if that didn't convince you, the best thing is that an annual plan is only $99. That's only 27 cents per day through my referral link down in the description below. Normally, premium is $239, but they are currently running a general offer for $119. But if you use my link, it's only $99. So check it out if you're interested. As a value investor, you're ultimately trying to conduct your research as if you're going to own 100% of the business, and you can understand its essence and know what's important and what's not important for the company going forward. So in addition to other sources, one resource that's an excellent perspective of Walmart as a business is Sam Walton's autobiography, Made in America, where he details his life as well as the founding and the rise of Walmart. It's a very good book that gives insight into his thought process and how Walmart really came to dominate American retailing by putting stores in rural America that delivered extra value as discounters and by really being relentless on learning from their competition. So through deeper research into the business, you'll ultimately learn more about the qualitative and the quantitative aspects of Walmart, and you'll likely be able to determine for yourself what an appropriate intrinsic value for the company will be. So with that said, that's it for today's fundamental stock analysis of Walmart Inc., ticker symbol WMT. If you enjoyed today's video, please be sure to like the video, subscribe to the channel for more stock analysis videos, and comment down below what business you want me to take a look at next time. Thanks for learning about Walmart with me, and have a great day.